Good morning and welcome to this Wednesday, December 21st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, currently we do show futures higher. We haven't seen that much of late. We've seen a pretty steady downtrend. Of course, we saw a big gap up with the CPI report that came out last week, and that didn't last. We had a big gap up and a huge sell-off afterwards. For me anyway, the number one question today is whether or not this gap up holds. Obviously, that would be much better than the alternative of seeing another day of heavy selling after a gap up. That's more of a sign of distribution when we gap in the morning to the upside and then sell off during the day. I have noticed that over the last several days, we've been actually performing pretty well in the market after 2 o'clock. And that's been a theme in 2022, where we've seen gap downs. And this is especially true since May 20th. That's the period since May 20th that I'm calling the bullish manipulation phase, which has been going on for a very, very, very long time at this point. But we've seen continuing net gap downs and early morning weakness, followed by accumulation throughout the balance of the day. And so that kind of aligns with the idea that we are going through a bottoming phase and that we will eventually turn back higher on a more consistent basis. But this is the kind of day that could, kind of put a monkey wrench in that. Anytime you see the market gap up and then fail to hold it and sell off during the day, especially if it's one of those days like last week after the CPI report, where we have this huge gap up and then sell off all day long. And then after the Fed announcement comes out again, just continued selling. That's been wreaking quite a bit of manipulation and mostly distribution. Actually, I shouldn't even say manipulation. That's been more distribution than it has been manipulation. So the post 2 o'clock buying, I think, is more manipulation. We're getting the gap up again. Let's see if it holds. I think that's going to be a big story today. We're getting toward the holidays. I expect lighter and lighter volume, which means manipulation could become heavier. It's a little easier to manipulate if you're a big Wall Street firm with deep pockets when volume is not as great. I mean, you can begin to dictate certain things. That's one of the reasons why I believe we have the Santa Claus rally. I think that once folks go on vacation and you don't have as many traders active during the day, I think it's a little easier for markets to be manipulated one direction or the other. So we've got the holiday coming up this week. I do want to mention that this is the last live Trading Places live show of 2022. Certainly appreciate all of you for supporting us this year. Thank you so much. We really do appreciate that. Wouldn't be doing this if we didn't have an audience. So thank you so much, and tell your friends and get everybody excited to come on board and listen in. I try to be objective. I know some of you think, oh, you're a perma bull. Well, no, I'm really not a perma bull. Just the market goes up more than it goes down. I certainly was not a perma bull the first 6 months of this year. Anyone who followed the show and followed me at Earnings Beats knows I was very cautious, very bearish, and I didn't turn bullish until mid-June. And I don't think I need to apologize for it. I mean, we're higher than we were back in mid-June. So if you got out of the market at the beginning of the year and you got back in mid-June, you're having a pretty decent year relative to what's been going on in the S&P 500. Anyhow, I try to share my thoughts, what I see in the market, and then kind of go from there. I'm not going to be right all the time. In fact, I wrote a EB Digest article this morning, really to that point, simply saying that, hey, nothing goes according to plan. You just can't get it all right. And I even made an analogy. Many of you probably know I'm a big golfer, been golfing all my life. Used to be a really good golfer, still a good golfer. And so I really look up to these guys on tour and gals on tour that have made it and that have risen and become the cream of the crop, and gone to the top. And I was listening to Rory McIlroy, who's currently ranked as the #1 male golfer in the world. And he was being interviewed I want to say maybe it was a month ago, maybe it was longer than that, I don't know. But he was making comments in his interview saying that, I'll never figure this game out. And you look up to someone like this, who I believe right now is the top golfer in the world. And he's basically saying, I keep working at this and I keep trying to figure it out. And of course, all of us other golfers are like, wow, I wish I didn't figure it out like you didn't. You haven't figured it out. But when I look at the stock market, I think some of the same things, beginning of the year, I really felt like this was going to be a challenging year, and it has been. But I thought by the end of the year, rates would start coming down, which they have. But I thought growth stocks would explode to the upside. And I'm going to show you a chart in a little bit. And it was the chart that I showed in the EB Digest this morning. I think it's gone out, but if it hasn't, it'll be out shortly. And I was just pointing out that while rates have been dropping rapidly here over the past couple of months, growth stocks are doing nothing relative to value stocks. Got a little bit of a pop, maybe 2 months ago, but then they've been on the decline, which, you might have a lot of different reasons and why it's not happening. But I can just tell you from my standpoint, being a former practicing CPA who did valuations for companies, falling interest rates will drive valuations higher on all stocks, but particularly those that can grow their earnings rapidly. That's not my opinion. That is fact. That's how you value companies. And so, I kind of feel like McIlroy, when he goes out and he has a bad round. It's like he knows he can play golf. He knows, all the practice and all the things he's done over the years. It's almost second nature. And I feel like when I'm looking at the stock market, sometimes it's the same thing. I've done all this research. I know what makes the market tick. I know what makes these growth stocks tick. And yet the lower interest rates is not making them tick right now, which you just say, hey, I don't know if you can ever figure this game out totally. But I'm not giving up hope. I still believe growth stocks are going to do well in time, especially if rates remain low. Let's not forget, by the way, I know we're talking about high rates. Go back and look at the 10-year Treasury yield for the last 40 or 50 years and tell me if you think rates are high. We've got a 10-year Treasury yield at 3.6%, 3.65%. Actually, right now, 3.63%, down 5 basis points this morning. If you compare that to history, we are way down in the lower end of where interest rates have been throughout history. This is a good spot for growth in the U.S. to have interest rates at this level. We got spoiled by 0% interest rates. It doesn't happen. We had some very low rates back in the 1960s, early 1960s, and then rates started to rise throughout the 60s. And the 60s, the stock market still went up. Where you have to worry about rising rates is when we get to areas like 5%, 6%, 7%. That becomes a major, major drag on economic growth. So don't write the market off. I know it's come up a lot, and it's more the pace of the rate hikes than it is the actual rate where we're at that bothers me the most. And I think that's what's bothered the market, because when we went down to zero, remember, growth stocks exploded in 2020, exploded. And so I think some of what's happening is they're still giving back some of those ridiculous relative gains that growth stocks saw over value stocks back in 2020. I think it's normalizing, and then we'll get back into the norm. Going through this pandemic, by the way, has been quite a treat. And I say that in a somewhat sarcastic way, because none of us has. I've done a lot of research in the market. I've done no research on pandemics because it had been 100 years since we had one. So trying to figure out the playbook for pandemics is not one that's readily available. It's not easy to figure out. Anyhow, I'm just rambling on, but let me take you all over to earnings beats here. So if you scroll down just a little bit here at earnings beats, I just want to make sure everyone is aware. While I think I did a really good job with the forecasting of 2022. I think I had some really good points and some significant points that hopefully saved a lot of folks a lot of money, especially in the first half of this year. As I just said, I wasn't perfect. The end of the year, I thought the market was going to really rally. We actually saw it in the Dow Jones. Dow Jones has had a really nice run until just recently. The S&P did pretty well. And then there was the NASDAQ, the growth-oriented NASDAQ that has struggled even while rates have been dropping. That's been the thorn, I think, in the predictions that I made back at the beginning of the year. But anyway, coming up January 7th, it's time to just kind of erase the chalkboard and start all over again. Market Vision 2023. What do we see? Dave Keller, Julius DeKempenaar, Grayson Rose, all from Stock Charts, good friends of mine, experts in what they do. I've worked with these folks for a long time now. I have tremendous respect. They're also great friends of mine, and they're joining me on Saturday, January 7th. They're going to give you their take on the market. So you're not just going to be getting mine. You may like mine, you might not. You might agree with me, you might disagree with me, and that's fine. That's what makes a market. Everybody comes up with their own ideas, and they put their money where they think it's going to go, and then we see what happens. This is certainly not a slam dunk kind of a thing. It's not, a math quiz or something where you know that there's an answer that's a right answer. Anyway, come join us Saturday, January 7th. Register now. Registrations are exploding. I figured we were going to get a big turnout, and it's continuing to get bigger and bigger. We are very likely to run out of capacity. And so as a result, please register now. Click on that button, sign up. Even if you can't make the event, or if for some reason we fill up, you can't get in, we're going to send out recordings shortly after the event. They'll be time stamped. You can always go back and listen to it. Make sure you sign up so you'll have that opportunity. All right, so let's move on. A lot of talking there, more philosophical than anything, but let's talk a little bit about what happened in the market on Tuesday. Dow Jones Industrial Average up 92, S&P up 4, NASDAQ up 1, mid caps up 12, small caps up 4. Good news, we finished higher on the day. And if you've been watching the market the last 5 or 6, 7 days, you know that is something new and different, because we have not been closing up, we've been closing down. And with futures today strong, perhaps this will be the start of a leg up, which would coincide with history, the Santa Claus rally, and everybody has a little different definition for the Santa Claus rally. For the most part, for me, it's just second half of December. Some folks think it's just the couple of days leading up to Christmas, maybe the week after Christmas, maybe even the week into the new year, first weekend of the new year. I've seen all kinds of different definitions of what constitutes the Santa Claus rally. For me, I know the second half of December historically is one of the most bullish periods. If not the most bullish 15-day period of the year, it's probably one of them. Now, when I sent out the December seasonality report to earnings beats members at the beginning of the year, beginning of the month, I always point out the times of the month where the stock market, where the S&P 500 tends to perform well and when it tends not to, based on history. Usually it starts out strong, goes through about a 10-day period, the middle of the month, 5th to the 15th, where we struggle. And then we do better the second half of the month. But there are 2 days where we tend to see weakness, even in the second half of the month. And I pointed this out back at the beginning of the month. It's the 19th and 20th, the last 2 days that we just went through. Monday and Tuesday, we saw mostly down movement. We did get a nice rally yesterday into the close. Got a little bit of a rally again afternoon. And so now, hopefully, the seasonality kicks in and we get a strong finish to the year. We will see. Like I said, futures up, crude oil up, $1.50, up almost to $78 a barrel now. 10-year Treasury yield down 5 basis points this morning, right now 3.63%. So maybe we're starting something. That's why I want to see the intraday action today. If we can rally, if we finish up today from the open, I don't care if we come down in the morning. That would be kind of typical. But I want to see a strong afternoon. I want to see a finish above the open today, or at least at it. That would make me feel a little bit better about the current market environment. Moving on to the sectors. Yesterday, we saw energy do well, up 1.5%. Dropped off to communication services, which was up about 2/3 of 1%. Materials up about the same. To the downside, discretionary stocks have been awful, and they've been awful for a number of different reasons, but primarily because of the autos. I don't know if you're following Tesla. Tesla and Amazon make up close to 50% of the XLY. Tesla's been in a free fall. Tesla was $200 a week ago, closed at $137 yesterday. I mean, that's 30% in a little more than a week. Maybe it was a week. 30%. That's a bad bear market. And Tesla's done that in about a week's time. Now, I can sit here and make excuses for Tesla, but the market's telling us something. I think long-term, Tesla is a great investment. Short-term, I'm not sure we've seen the bottom. Market's telling us the volume's been very, very heavy on Tesla. Anyhow, Tesla's weakness, Amazon's weakness, really contributing to an underperforming discretionary sector right now. And the XLY XLP ratio that I like to follow is down close to the 2020 low. That needs to hold. In other words, we need to start seeing some money rotating into discretionary. I think a breakdown starts to paint a much bleaker picture of the economic picture ahead. And this is, one of those ratios that I like to follow. Tells me a little bit more than just what the S&P 500 is doing. Keep an eye on discretionary. We really need to see that pick back up again. You can see the breakdown. We're back down below the October low. If the whole market was doing what discretionary stocks were doing or are doing, we'd be at an all-time low, or not an all-time low, but a 52-week low. We would be at our 2022 low right now. Anyhow, real estate also down about just under 1/4%. Real estate, this is one that's going against the grain seasonally. December, real estate tends to really enjoy the month of December. Well, last 5 or 6 days has been painful. We were actually at a December high, but you can see this last week or so has really taken a toll on some of the real estate names. Look for this group maybe to rebound into the end of the year. 10-year Treasury yield. All right, well, first, looking at the economic reports out today, we've got consumer confidence coming out at 10 a.m., expected to rise a bit to 101. November was 100.2. So we're looking for a little move up in consumer confidence. November existing home sales, October was 4,430,000 units. November is expected to decline to 4.2 million units. And if I bring up this group, and I'm going to do that in just a second, but first, just wanted to point out the 10-year Treasury yield yesterday broke above the 20-day and is pulling back today, perhaps to test it, which is at 361. Watch to see if it holds. If that holds and we turn right back around and shoot back up into the 370s, it's starting to look a little bit like what we saw in mid-August when yields started to rise again. That was not a good thing for the stock market. So are we starting what we did again back in August? Again, I'm just trying to keep it real. I said on the way down, this was good for the market when the yields were dropping, but to be careful if the yields come back up. What I would like to see is the stock market rally into year end and to see the yield come back down below the 20-day. Make this a false breakout. Come back down to that 340 level. That would be much more bullish, a much more bullish setup for equities, in my opinion, going into 2023 versus the yield starting to move back up and trending higher again. All right, I mentioned the home builders. Of course, yields have been coming down. Now all of a sudden they're going back up again. The news on home builders has not been good. If you've been watching the housing market index, not good. Housing starts and building permits, not good. I'm not expecting good reports. However, when we look at the home builders, and I'll get rid of these ratios down here, but let's just check the home builders relative to the S&P 500. So here's the home builder group. You can see we were downtrending. Remember, rates have been going up all year, but in June, home builders bottomed, started rallying, pulled back, and now they've rallied and taken out those earlier highs. So now, right now, the home builders are living in an area where they hadn't been since back in March. And keep in mind, yields kept going down through October, yet home builders were higher in October than they were back in June. Their relative strength bottomed all the way back in April. Money is rotating into home builders. Think about for a second what that means. Why would Wall Street, why would the big firms be putting their money into home builders as rates continued moving higher? Well, my theory is the stock market looks ahead. And so the stock market is looking ahead thinking rates are going to top. And therefore, it makes sense to get into home builders when they are low, when they are beaten down. And that, in my opinion, is why we have seen this crazy relative strength going on now for 8 months. We're pulling back. We're hitting the 20-day moving average. This is probably a great entry into the group. But what if interest rates, they've now broken back out of this downtrend? What if rates start to go up and the market starts believing that, you know what, maybe the Fed is crazy enough just to keep raising rates? And I say crazy because I think they're crazy right now to keep raising rates, what they're doing, based on a lot of the signals. I don't know if you're looking at housing. A lot of the housing signals that have been coming out are not exactly inflationary. That's a pretty big part. Look at the consumer stocks. Look at what commodities have done. All of them are way off their highs. And yet the Fed seems adamant to just keep raising rates. I think it's a mistake. And when I said I got things wrong this year because the growth stocks really didn't do at the end of the year what I've been expecting them to do, I think a lot of this changed when Fed Chief Powell had his Jackson Hole speech in August. I think that's when the market just said, wait a minute, what's going on? And I think it's almost a lack of credibility of the Fed, more so than whether it's inflation or whether it's a recession. I think that the market has lost some confidence in the Fed. Market was expecting the Fed to be a bit more dovish and maybe start slowing their rate hikes sooner than they did. And instead, the Fed turned around and said, there's more pain ahead. We see more rate hikes. And they started to raise where they think interest rates are going to go. I think that kind of changed the picture. But the bond market continues to send a message to the Fed, stop raising rates. I look at the bond market now. You look at these treasuries and the treasury yields, and that's the only story that I can really decipher based on the charts. The bond market is screaming to the Fed, stop. And so if the stock market keeps going lower, I think personally, tip your hat to the Fed because I think it'll be Fed induced. Just like it was back in December of 2018, by the way, when Fed Chief Powell, of course, the Grinch back then, now the Grinch again. Back in 2018, remember, right before Christmas in December, he said, we got 2 rate hikes ahead. Caught the market completely by surprise. The stock market over the next week collapsed and hit bear market territory. You know what the Fed ended up doing the following year? They cut rates in June. They never raised. After saying we're going to raise 2 times, they never raised. They cut rates in June or July of 2019. I think Right now, the markets are sending the Fed a very similar signal. Are they listening? Are they going to listen? I don't know. If they listen, I think we'll see that growth stock explosion happen. If they don't, and they continue to go about their ways of raising rates, I think number one, it's a big mistake. I think number two, it's lowering the valuations of a lot of these growth stocks. And number three, I think they're going to trigger a recession much worse than what we could have experienced. And again, I don't even know what they call recession anymore. I know they don't follow GDP. I mean, we already had 2 quarters earlier this year of negative GDP. That used to be. Now it's like we're just going to wait for the government to tell us. Well, I don't know when they're going to tell us. I mean, I still see discretionary stocks putting in new lows in 2022. Amazon sitting at its lowest level in a while. I mean, these are really big names, Amazon and Tesla, that are going nowhere, rapidly declining. That to me is a signal of maybe a worse recession than feared. Anyhow, that's enough for the home builders. Make of this chart what you want, but look at the home builders relative to the S&P 500. The market is anticipating lower rates, or at least the Fed putting the brakes on their rate hikes. That's what the market is anticipating. Before, when home builders were absolutely getting clobbered, 1,700 at the beginning of the year, down below 1,000 by June. They've been doing much better now, so we don't really think back to how bad it was in the first half of the year. Home builders were devastated back at the beginning of the year. It's because the market anticipated the rate hikes. Now we're going up. Relative strength is moving up. Why? Well, I gave you my reason. S&P 500. This is what I was showing on I'll get to that chart in a minute. S&P back down below the moving averages. We went back down below this gap support. I didn't like that. I thought that was a game changer with that October CPI report coming out there. And then with the November coming out here, market, the Fed said, hey, we want a series of low inflation. So we give them 2 months in a row. And now it's moving on to something else. Anyway, not going to keep ranting there. But we lost that gap support level. So technically it brings in the bottom of gap support. We're not quite there. We could get there, but we are in this gap support zone. I'd like to see the market rally from here, get back up above these moving averages, get that PPO back into positive territory. Is it going to happen? I don't know. I don't think we can assume that it's going to happen, but that's what I'd like to see. The NDX. Similar story, actually, on a relative basis. We're closer to the lows back in October. This gets a little bit to that point of growth stocks. I'm going to move back to the S&P and show you these charts. So here's the S&P 500. This is the 10-year Treasury yield. So the yield was going up, up, up. Market was going down, down, down. Then we had this nice little pullback in the yields. I thought that was it. Called the bottom back, by the way, on mid-June. I think it was on June 16th, right here. Rates started coming down. There goes the stock market. Everything looked good. It looked like I was going to have an absolutely perfect call for 2022. And then this speech happened right here, August 25th. And look at what happened after that. S&P getting torched, and look at the yields going up. Also, the QQQ versus the S&P 500 going down, which is unusual when the rates come down, but not so unusual when rates go up. Look at the rates going up. Rates go up. Normally, growth stocks get hit harder. There you go. The Fed sent the stock market a curveball. When rates were starting to come down, growth stocks, the QQQ was outperforming. Then we go up in the yield. QQQ comes down. But look at this. The 10-year Treasury yield drops almost 100 basis points. And this relative ratio keeps dropping. We're not at a low, but the downtrend is in play. This uptrend isn't in play. So these last 2 months have been the Rory McIlroy of stocks for me. It's like, what the heck just happened? I thought I had this game figured out. 10-year treasury yield goes down and growth stocks are not reacting. Here's large cap growth versus large cap value. Here's another large cap growth versus large cap value. You can see over here, IWF, IWD, DJUSGL, DJUSVL. Then you've got medium, mid-cap growth versus mid-cap value. Look what's happening. Look, last 2 months, yields have dropped 100 basis points, almost 90. Small caps, we've seen a little bit of a tick up in growth, small cap growth versus small cap value. But otherwise, nothing. With yields dropping like this, makes no sense. Except the Fed has lost, the market has lost credibility or has lost belief in the Fed. And I think that's part of what's going on here. Anyway, stock market has opened. I do just want to mention gold has been performing really well. Had a member write in and talk about gold, and I actually have seen this recently. Gold's been performing well. The dollar's been coming down. You can see with the dollar topping, we had a triple bottom on gold. As the dollar is rolled back over, gold's going up 18.25. That was the reaction high back in August. Where are we at right now? We closed yesterday, 18.25. Let's see what happens with the dollar from here. What happens with gold? Beware possibly of if we do move down in gold one more time, it could be a right shoulder, reverse right shoulder. Coming down, 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 left shoulder, neckline, triple bottom head, right side of the neckline. And if we move down one more time, it could be the right shoulder. This could be developing still into year end and into maybe the first quarter of next year. Or maybe we just break right out. That's possible. You don't have to have a bottoming head and shoulder pattern, but I'm at least seeing the possibility of one. So I wanted to point that out. Now, on a relative basis, look at gold relative to the S&P. It has broken out. Gold right now versus the S&P 500 is at the highest level we've seen since back in June. So the dollar falling pretty substantially, I think, has triggered a lot of folks moving back into gold. All right, let's take a look at what's going on in the market. Then we will wrap up this last live Trading Places show of the year. Currently, we got the Dow Jones Industrial Average up 304, S&P 24, NASDAQ 33. But look at the disparity once again. Rates down. I mentioned it. Let me see where they are right now. I'll tell you. Right now, down 4.4 basis points, down to 3.64% on the 10-year Treasury yield. And the NASDAQ is underperforming again with rates coming down. The other thing to look at, the VIX back down to 20. I know those of you that there are still a lot of folks that are bearish, think this market's rolling back over and going to head lower. What I can tell you is that when the VIX continually starts to show lower highs and starts to drift lower and lower and lower, it's a signal that fear is coming out of the market. And if fear is coming out of the market, the stock market's not going to go lower. It's just one signal. It's a secondary signal. But I'm telling you, based on my research, if you go back and look at every bear market bottom, cyclical and secular, a lot of times the final low comes with the VIX not as high as it was previously. In other words, as the market keeps dropping, fear comes out. And it's almost like the market has oversold itself. There's not enough sellers left. So while individual investors like you and I might be looking at the news and still very fearful, you're looking at some of the institutional investors that are saying, hey, you know what? I kind of like the way the market is. I'll buy those shares. So you're getting more choppiness. The VIX is dropping, meaning options premiums are lower and lower. Market makers, the big firms, are willing to take lower premiums on options. That's a pretty good sign that volatility is not going to go up. And if volatility doesn't go up, the stock market is not likely to go down. Anyway, I'm going to end this last live 2020 performance on that note. Please be sure to register for Market Vision 2023 coming up on January 7th. Again, I got a lot of great friends and experts coming from stock charts to join me. It will be a great event. Best of all, it is free. We do this to give back. It's one of the things I do. I think this is a very valuable, information-packed event. It's really nice for the folks over at Stock Charts to take time out of their Saturday to come over and join me, doing all of this for free, trying to help folks navigate the market for 2023. Make sure you sign up. That's it for me, everybody. Have a great day. Have a great rest of your year. Happy New Year. Happy 2023. Hopefully it'll be a much better year for us as we move forward. Happy trading.